Okay, so let's move on to the next piece of the podcast then, Damien. We're going to be talking about investment trusts and discounts. So you got a piece on this?
Yeah, so investment trusts, if you go and invest in an investment trust, you're very quickly going to come across something called a discount or premium. And so I want to just run through what this means, what is the impact for investors, pros and cons, and whether you should buy at a discount. So thinking about an investment trust, the structure is different to a unit trust. It's essentially a company structure where the company invests in assets. So you're effectively buying shares in a company. So those companies are usually floated on the stock exchange, and that company will invest in those underlying assets. So that means that the assets that the company might invest in, and if you go and look at an investment trust, it can be all sorts of things. It could be UK equities, so it could be other companies out there. The net asset value is the value of the underlying assets that they've bought in totality. So you might think, well, the share price of that particular investment trust that you're looking to buy is just going to be equal to the underlying value of those assets. But that is usually not the case. The share price of the investment trust can be higher or lower than that net asset value, the NAV. And that discount or premium will obviously affect the price that you pay for the shares of the investment trust. So it leads on to that question of, should you buy an investment trust at a discount or premium, and why would that occur? So the reason that you might get a discount on an investment trust could be market sentiment. So it could be investor sentiment towards particular sectors or the manager of that particular investment trust. So they could be sitting there thinking there's some reason they don't value that manager, or they think the value of the assets that they're holding is actually lower than they're reporting for some reason. It could be a good example. They could have some unlisted shares, and the problem is with some unlisted shares, it could be private equity, for example, the valuation will be based upon the last known transaction. And so the value that may have been applied to that, the market might actually think, do you know what, things have changed, I'm not sure that value is still correct, so we're going to probably price it a bit lower. So they're not willing to pay the full price, like the NAV value, for that particular investment trust. So that could drive a discount, for example. And usually discounts can be for a short period of time, but they can last for years. And so the other reason you might get one is past performance. That can influence the discount or the premium. So if an investment trust does really well, then what will happen is that people might decide, if it's done well, they want to invest in it. Now, with investment trusts, it's not like unit trusts where the manager creates new units to effectively allow people to buy into the fund. So those units are created and those people buy those units and then their money is invested. With an investment trust, there is already a stated number of shares. The number of shares doesn't change. So therefore, if people want to invest into that investment trust, they have to buy shares that are already in existence. So they will buy them from existing investors. In the same way as you would do ordinary shares, you would buy and sell on an exchange. So therefore, if there's a big demand for them, because people might be looking at the performance of that investment trust, say, I want to be part of that, I want shares in there, they're therefore going to have to pay more for them because it will drive the price up. Just like if you go and want to buy shares in any company out there, if there's a greater demand, then there is supply, the price goes up. So that's why we see the price movements. Equally, it could be that the performance hasn't been great for that investment trust, and there are more people wanting to sell their shares in that investment trust than people want to buy them. So it causes the price of the investment trust to fall and therefore deviate from the underlying value of the unit trust assets, so that net asset value. You can also have discounts because of liquidity issues, so the size of a fund, so that can start to cause funds to trade at a discount. I'm going to come on to something that explains that a little bit better in a second when it comes to what managers do about discounts. It can be overall market trends. It could be they invest in particular sectors. It could be infrastructure, for example, and the market appetite for that particular sector, exposure to that, starts to fall, and that starts to impact the share price of that particular investment trust. So you're in this scenario that you've got two things to think about when you're buying an investment trust: the underlying net asset values, the assets themselves, but also the share price. So there can be positives of buying at a discount. So I'll run through some of the positives now. So there is the potential for you to get value because you are effectively paying less for the net asset value of that particular investment trust. So if you could have, for example, you could have the value of the underlying holdings go up within the investment trust. So that can be a performance driver, but you could also have a narrowing of that discount. And in fact, it could go into a premium. So therefore the price of the shares could go up as well because the discount is narrowing. Of course, it can go the other way, but that could be a positive, so a double kicker. So that's going to boost your returns. I mean, there can be a potential for higher yields as well. And this is the thing I don't think a lot of people realise, that the dividends paid out by investment trusts is based on the NAV, so net asset value. But if your shares are at a discount, then your yield is going to be higher. Of course, the opposite is true if you're buying shares at a premium. So if your shares in the investment trust you bought them at a premium, then the yield could be impacted. So that's quite a positive for income investors. And of course, it can also be an opportunity for you to do a bit of active management, because you might be interested in a particular area of the market, sector, exposure to certain themes, whatever it might be, and you go and buy an investment trust deliberately that's at a discount because you're hoping that it's going to narrow at some point as well, because it's a theme or something you want, but you're getting it cheap.
So there's a double element there to someone who's looking primarily into areas at a discount, purely to take advantage maybe of that then increase in the future, but they're going to get that yield sort of kicker as well. So there's a double element there for those value hunters.
Yeah, and so it does make it a potential trap, like a bit of a minefield. You've got to have to do your research. And of course, that's one of the cons of it. There is that potential for a value trap, because you could buy something at a discount and it's fundamentally a reason for it being at a discount, and that discount could widen. It could be poor management, for example, and that's why it's a discount. Or it could be undesirable assets that they're investing in. So there are assets you buy into it, but actually the things that they're holding aren't particularly desirable, and it could be down to things like private equity, or it could be some of the unlisted shares. Don't forget, investment trusts also have leverage, so they can borrow money to invest. So that is another thing to factor into all this. So the volatility you get in the share price can be an issue as well, because you're going to have more volatility because you've got two moving parts. You have that NAV, but you also got the discount or the premium potentially in that swing. So that is something that can be a con to investing in investment trusts.
You mentioned private equity a couple of times there. That seems to be a little bit of a trap potentially for people. Is there an easy way to spot how much private equity there is in it?
You should be able to see all the information on the fund fact sheets. So that's the key thing. You've got to do your research and on anything you want to invest in. So you should be able to find that information anyway. The other thing I want to go on to, though, is there is that risk of wind up as well, because if you think about it, if the discount became so cheap and the net asset value is obviously much higher than the share price, there does become a stage where you may as well wind it up because return the money to investors effectively, wind up that investment trust. But unfortunately, you can't make that happen individually. And the other thing to bear in mind is if you are ultimately forced to exit in this way, that can create a potential sale at an unfavourable price. It can create a tax liability as well. So these might not be likely, but they are distinct possibilities. There is the other issue: if people are trying to sell, it will drive down the price. The discount can widen, so the discount itself can start to become a problem for people who are trying to sell their shares. And one of the other cons is something that I'm going to come on to now about the management and what they can do about it, is the cost of taking action. So managers can sometimes take action to narrow the gap. So trading at a discount isn't necessarily an issue, but over the long term, managers may want to try and bring it in and narrow it. And some of them have policies. So let's say, for example, the discount gets to a certain point, they automatically trigger actions that will try and narrow that discount. And that can be done by things like buybacks. So they may sell assets and then use that money to buy back some of the shares that are out there in their investment trust. And so by doing so, you reduce the number of shares in existence, and therefore it will drive up the share price. So that is something that can be triggered automatically. by some investment trusts, but it could be a decision they make as a management on an ad hoc basis. And the issue with that is that starts to, when you're smaller, that can start to increase costs in doing that. And it also starts to cause the fund to shrink in size in terms of the asset value. And that in itself can also lead to the potential for things like wind up. Now, the other thing is, of course, if shares are trading at premiums, managers could do the opposite and they could issue more shares to try and bring that down to make their shares more attractive. So there are things that managers will try and bring it down. I think the discount is more likely to drive some sort of management action, but you will get cases where they will issue new shares because obviously the demand for that particular investment trust. And don't forget that the overall performance of an investment trust will be partly determined by the movement in share price, but the net asset value as well. So they are going to be looking at their share prices. And the other thing they could do, of course, is to try and change the assets within the investment trust as well. So you've got to think the discount is the price versus the net asset value. So you could try and change the portfolio itself. Overall, if there is a policy for a well-managed investment trust that manages the discount, and it will tend to move towards the long-term average over time. So it will tend to move towards that NAV. So it is a positive thing, but you have to look out for it. So there can be issues for investors. We mentioned it before. There can be capital gains that can be caused by some of the actions. You have to look at the fact that when you buy at discounts and premiums, there's the income impact. If they start to try and reduce that discount, then that will have an impact on the potential yield for investors who are going to, new investors I'm talking about. Again, volatility, you're going to start seeing volatility in the price of that investment trust. And of course, if there is a discount or a premium and there's a management of that, that could influence an investor's decision of the timing if they want to try and exit from it. Because let's imagine if there was a big discount or a discount was winding, somebody might not decide to sell at that point. So the management of any discount or premium could start to impact the decision of investors when they might want to sell, because like we said earlier on, that has an impact on the performance from the investor's perspective of that particular investment trust. So it's something that I think is quite interesting and people haven't thought about. So just for completeness, I just got to talk about the pros and cons of a premium. So if you buy a premium, that could be an indicator of strong performance, not necessarily, but often, and quality management. But on the con side, you could be overpaying for the underlying asset, and you could see some volatility in that share price because if you're paying at a premium, if that demand starts to evaporate, you could see the share price drop, even though the net asset value hasn't changed. So that's a possibility as well. And of course, we talked about it earlier, the reduced yield if you're going to invest in an investment trust at a premium. So from an investor's point of view, obviously, when you do your research, you want to be looking at the investment trust you're going to invest in. You want to look at whether there's a discount, whether there's a premium. You might want to see if you can find historical records of what they are. You might want to look at what others in a similar field have a discount or premium, because don't forget, it could be partly because of the market sentiment rather than actually anything fundamentally to do with that particular investment trust. So you want to do your research, work out why potentially it might have a discount, but also over the long term, you have to realize short term, there could be some fluctuation in these prices that could hurt investors. But investment trusts probably are quite well suited for people holding them for the longer term because of these sort of double whammy in terms of volatility variations, NAV and share price.